it's just a continuing story here, isn't it? And you can see with the announcement the pressure that all sides are under here. But I think there's an interesting aspect of this is we're talking a lot about supply, but there's not enough focus on the demand side, perhaps.
Focus on demand.
Yeah, I mean, because if we think about what we've discussed earlier about the strength of the global economy, lead indicators across all the major areas of the globe are picking up and pointing to stronger growth ahead. Now, other things being equal, that should support higher demand for oil going forward. So there does seem to be a disconnect. Our view is that we will start to see that demand side come through over the next few months. So we should see the oil price creep a little bit higher.
So what happens with the extension to March then if you do get a rebalancing? I think the market's been a little bit caught off guard by the inventory not being drawn down to a significant extent. What if there is sort of the opposite that happens? There's more of a drawdown than expected. Do you just see the end of the agreement early?
I suppose that's definitely a risk, but I suppose from the market's perspective, what we'd be concerned about would that actually lead to a spike, and if we were to see that, what are the consequences of that? I mean, I think that it's probably less of a concern now. I mean, a lot of, as we've discussed earlier, about the supply side and the ability to come on stream relatively quickly in other parts of the world, non-OPEC as well, should mean that some of that's contained. So, as an economist, I'm perhaps less worried about it, but yeah, it's certainly something that we've got to think about.
Do you see the V stocks coming down to the same kind of low number that we see for the VIX at the moment? Is the implied volatility for European markets also going to fall dramatically here as we see a continuation of the supply agreement and we see more money now finding a home back in European markets?
I think that's a very good point you've just made there about the flow of funds we're seeing into European assets now. Okay, political risk in Europe isn't over completely. As we've discussed, we've still got the French presidential elections, parliamentary elections, sorry, and more to come in Europe. But there's definitely a sense that Europe is much more investable today. And if that flow of funds continues, then yeah, absolutely, we could see V stocks drop.
I mean, what throws a rock in the calm of the pond? Because historically, we know that this only lasts so long, that whenever you get these very low prints around the VIX or the V stocks, ultimately you do get volatility return. When does it come and why?
Well, I think we've got to be realistic about this, that sometimes events are just unpredictable, and so let's not even comment about those. But I suppose in my mind, the big risk would be what happens to the economic data over the coming months. Now, we've had such a good run with the survey data that's pointing to pretty extraordinary levels of growth, and especially in Europe, and I think that's behind a lot of the flow of funds we've seen into Europe. If we were to get disappointments, and let's be honest about this, it wasn't just the US that disappointed in the first quarter on GDP prints. We saw a bit in France, other parts of Europe, and the UK as well. So there is this sense that there is a disconnect between the hard data and the soft data. Now, if that continues, in my mind, that could be a potential source of risk.